Welcome to The Explainer. Today, we are peeling back the layers of financial uncertainty to see what really, and I mean really, drives market risk. It's a journey that goes way beyond simple probabilities into a world that's just so much more complex and, honestly, fascinating.
You know, we often talk about markets using words like odds and probabilities, almost like we're sitting at a casino table. But here's the thing. While we might use the language of chance, the game we're all playing is on a completely different level. Think about it like this. A simple coin toss, right? It has fixed known rules. It's 50-50, period. But in financial markets, we are often betting without even really knowing the true odds. It's kind of like playing a game where the rules themselves are shifting with every single move you make.
Okay, so let's dive into this. First, we're going to explore how probabilities themselves aren't fixed. Then, we'll see why your personal journey in the market is so different from the average. We'll uncover the real shape of market risk, look at some of the super sophisticated tools used to model it, and finally, we'll tie it all together to see why any of this really matters.
So first up, we need to grapple with a concept that's a little mind-bending, I'll admit. It's the first layer of this deep uncertainty. The very probabilities that we rely on, well, they're uncertain too.
This has a name. It's called stochastic uncertainty. Now, stochastic just sounds fancy. It basically means random. So it's this idea that the probabilities themselves aren't set in stone. We have to start thinking about probabilities of probabilities. It's not just about the odds of something happening, but the odds that our understanding of those odds is even correct in the first place.
Let me break it down. The chance of a company's stock doing well depends on the economy, right? But the future of the economy, well, that has its own set of probabilities, which in turn depend on politics, new technology, you name it. It's this deeply nested chain of uncertainty, one layer after another. Okay, so the odds aren't fixed. Got it. But let's add another layer of complexity, because why not? The specific path you take through all those shifting probabilities can dramatically change your outcome. And this brings us to the really fascinating field of ergodicity economics.
And here's the core idea. It's about the difference between your own personal journey, that's the time average, and the average of a whole crowd at one single moment, that's the ensemble average. The key thing to remember is that in finance, these two averages are often not the same at all.
Now check this out, because this is where it gets really counterintuitive. This slide shows a bet that actually looks pretty good for a crowd, but it's totally ruinous for an individual over time. See, for the group, the average wealth actually goes up a bit. But for you, you start with $100, you play again and again, and after just one win and one loss, you're down to $90. You've lost money.
So the crucial point here is that in systems like finance, which are non-ergodic, it's your individual path that matters, not the group average. What works on average for 100 people playing one time can be a total losing strategy for one person playing 100 times.
Let's move on to our next layer and see how this all builds up. Because it's not just that the path is tricky, it's that the very nature of market movements isn't what you might think it is. We're talking about something called non-Gaussian returns. For decades, so many financial models were built on this, well, elegant but dangerously flawed assumption that market returns follow a perfect, symmetrical bell curve, also known as a Gaussian distribution. It's neat, it's tidy, it makes the math easy.
But here's the million-dollar question. Does reality actually follow that nice, clean model? As you can probably guess, the data from actual markets tells a very, very different and much wilder story.
And this image just illustrates the problem perfectly. That dotted line, that's the idealized bell curve. But the colored lines, those are real market returns. And you can see they have what we call fat tails. All that means is that massive, unexpected events, crashes and huge rallies, happen way more often than the standard model would ever suggest. So if probabilities are uncertain, and individual paths matter more than averages, and risk has these fat tails, how in the world do experts even begin to model any of this? Well, it means you need a much more sophisticated toolkit.
One really powerful tool is the hierarchical hidden Markov model. It's a bit of a mouthful, but what it helps do is detect the market's current mood or regime. You know, is it bullish, bearish, or just volatile? It does this by looking at both the short-term daily noise and the long-term monthly trends, all at the same time.
But you know, knowing the current regime is really only half the battle. From that starting point, we still need to explore the huge, vast range of possible futures that could unfold from here.
And this is where something called a Monte Carlo simulation comes in. Instead of trying to pinpoint one single future, this method is all about generating thousands upon thousands of potential future paths for an asset. It gives us a map of possibilities, rather than a single, lonely prediction. By simulating all these futures, like you're seeing here, we get a much richer picture of the entire range of potential outcomes. We can see not only the most likely path, but also the best-case scenarios, and probably more importantly, the absolute worst-case scenarios. So we've peeled back the onion of deep uncertainty. Let's move to our final section and bring all these ideas together to see why they're so incredibly critical for anyone who's trying to navigate the markets today.
Look, the modern way of thinking about finance isn't about having a crystal ball. It's about acknowledging these deep uncertainties, knowing that the odds change, that your path is unique, and that extreme events are actually pretty common. The goal just completely shifts from prediction to preparation.
And this all leads to the single most important takeaway. We need to stop asking what will happen and start asking a much smarter question. Am I prepared for what could happen? Embracing that shift from seeking certainty to managing uncertainty, that is the absolute key to making smarter, more resilient financial decisions.